The Fed seems pretty intent on overdoing it with the rate hikes. This is the new information that we got last week. This crazy long meeting he does, I believe once or twice a year, where he answers all these random questions about things that will make you want to fall asleep. But there were some key messages in there as regards to rate hikes, future rate hikes. So it sounds like the Fed is going to hike rates 2 more times. Whether we believe what he's saying or not is a whole other story, because if you remember last year, they were forecasting that they were going to raise rates 75 basis points, and then they proceeded to increase it 500 basis points. So we can't always rely exactly on what the Fed's going to do based on what he says he's going to do. But what we do know is that he definitely wants to signal to the market that they are hiking rates at least 1 more time, maybe twice. Why is this? Because he seems to be hanging on to this tight labor market data. Even though there's this economist named Adam Shapiro who did a whole bunch of research on this and basically says that labor cost growth has no meaningful effect on goods or housing service inflation. So basically what he's saying is that labor cost is a poor gauge on future inflation, what that's going to do to future inflation. In fact, it has little to no effect on inflation, yet Mr. Powell continues to hang on to this information. So basically, because of that, pretty much there's a 72% chance, at least the market is saying there's a 72% chance of a 25 basis point rate hike on July 26th at the next Fed meeting. So after that, though, they're saying there's an 11.5% chance of another hike after that. So the market is generally thinking that Jerome Powell is going to hike rates 1 more time in July, and then they're going to stay flat for the rest of the year, and then they're forecasting rate drops in 2024. So that's kind of what we're all thinking. That's what it sounds like. And then the information changed quite a bit, because really a couple weeks ago there was like a 0% chance of a hike, and then of course this meeting happened last week where he answered all these questions, and he definitely made sure to bring up the issue of rate hikes, inflation, job market, all of these things that are affecting his decision about whether to hike or not. Now it seems that he's going to overdo it, because obviously another 1/4 point hike I don't think is going to have, and this is general economists that are saying a 1/4 point hike is not going to really affect the market over the next 12 months in such a meaningful way. So why are we hiking again? Maybe because he wants to make sure that we get rid of inflation, even though it's down a ton since the beginning. In fact, supercore inflation is actually down about 2%, and then inflation as a whole is down about 50% really from where we were a year ago. So things are looking good for us, and it just may be that the labor market is going to continue to be tight, which doesn't necessarily mean anything for the market in terms of beating inflation. So anywho, that is what we're talking about in terms of rate hikes. Now, that being said, treasuries have been relatively flat over the last week, and the consensus is because the market had already baked in this idea that there weren't going to be any rate cuts until next year, and also the idea that there's at least 1 more rate hike this year. So treasuries have remained flat. It remains to be seen how rates are going to be affected. This week, we do have some more big information come out. We basically have another GDP and core PCE reading this week. So we will see how that affects rates, hopefully in a positive way. Banks are still super conservative. And another one of the things that Jerome Powell mentioned in his meeting last week is that basically banking is stable. Now, this is a really interesting thing for him to say, because he also did not address the fact that their emergency lending program that they came up with for banks, it just crossed the $100 billion mark, as he was saying that the banking industry is stable. So of course it's stable when they've lent out over $100 billion of cash. If you gave me $100 billion of cash for my business, I would feel really stable too. Anyway, all of that aside, lending is still available, still out there. Banks are ultra conservative these days. It's crazy. I have certain banks that have really strong borrowers, and yes, they do like a really strong borrower, but it doesn't carry the weight that it did, this time last year, for example. So they are still willing to do things for even super strong borrowers, perhaps that they wouldn't be willing to do for someone who is newer or had less experience. But it's really not that much more in terms of getting more loan dollars or getting more aggressive on things. They're still fairly conservative. And the reason is because they need deposits, and they are not sure what new rules are going to be coming out. So the one thing is for sure that the Fed is going to have more rules about how banks are monitored going forward. And because the jury is still out on what exactly exactly that means, a lot of banks are starting to prepare for these new requirements, and they want to make sure that they've shored up enough so that they're within those guidelines at the time that they get read or even passed. So they want to get ahead of it, which is a smart thing to do, right? So a lot of small banks are the ones who are being more competitive these days. And even some, it's kind of a 50-50 shot, just depending on how healthy they were with deposits, because some of our lenders that weren't competitive during this crazy boom that we've been having over the last several years are able to lend, right? Because they didn't do a ton of lending during that time. So their liquidity is okay. And they didn't lose a bunch of customers or deposits. So they are lending, whereas other small banks lost a ton of deposits. They were more aggressive. They had higher volume. They need more loans to pay off, like that sort of thing. So they're more conservative and requiring deposits to even do business with them. So again, I've been saying this for weeks, months even, but the market is changing quickly. Lenders are coming in and out of the market. Rates are going up and coming down. Whether the treasuries are going up and down, lenders are gauging, are basically trying to control volume through interest rates. So they have always done that, but it's just more volatile than it ever has been before. So you definitely want to make sure that you get all of your quotes updated weekly at least. And so yes, and I also took a look at our inventory, because one of the things that I know Kenny, my husband, that does the residential side, he's saying that inventory is down significantly. On his side, inventory is so ridiculously down, but it's also down about 50% for us too. So if I went on to LoopNet and looked at all the listings that are available in San Diego County for 5+ units, there were 81 listings as of this morning. So a healthy market for us is at least 150 listings across San Diego County. So we are definitely very low on inventory. And then it's just really tough to make the numbers work, right? Because cap rates have gone up a bit, but it kind of doesn't really feel like it. So if you're getting rates that are close to 6%, then it's just really tough to buy a 4 cap. So that has not changed since last week. That is still the same. Now, the other thing that was interesting is that rents in San Diego. So if you look at residential, for example, in higher end neighborhoods like La Jolla, for example, rents, I am seeing that homes are sitting longer and rents are coming down a bit. But San Diego as a whole, rents have gone up. In fact, they've gone up like a decent amount, but I would say the average for this year is about 5% across the board so far, but certain areas are having more appreciation than others. Of course, the beach communities are having a smaller increase. Wherever it's more expensive, they're going to have less of an increase. Downtown, UTC, because they've got a bunch of like newer, nicer product and stuff like that, but they have not seen as many increases as, for example, National City. But even some of the other, areas of San Diego have seen like decent increases. So some of that older housing stock that's not luxury, high end, is seeing just kind of normal rent growth, right? We're not seeing like a 12 or 13% or 17% increase on rent like we did last year, but it's now more average to like 5% if you do a 12-month average from May of last year to now. So rents are going up, things are stable, and I think it's going to continue to be that way for your kind of just vanilla bread and butter mom and pop apartments. So anywho, that is my update for this week. You guys, thank you so much for your support. If you like my videos, please let me know. I love hearing from you guys, and I will see you next week.